In this module, we're going to be going over how lenders and banks and institutions make a lending decision. What are they looking at and why? And how can you curate a better borrower narrative or better reflection of your business and establishment to have a higher likelihood of approval? That's what we're working on. Number one, we're going to begin with bank statements. Not having negative days, that's important. When you have a negative period, a negative day, negative net income, meaning losses, you're showcasing negative repayment ability, meaning you have less than $1, you have $0 or less than that to repay a loan. This, in the eyes of a lender or bank, is risk. And anyone who writes these high-risk loans are going to make them very high cost, which is counterintuitive and productive. So you're telling me that someone who has less repayment ability, illustrated in their financials, should get a higher payment rate? Doesn't seem to make sense, but that's the reality. That's how business operates in business lending, and that's when you run risk of only being eligible for terrible predatory financial instruments that aren't even truly loans, which we'll talk about. So what can we do to ensure the best possible light that my business is viewed in? And that would be maintaining responsible practices in the business checking account. This is first and foremost. We'll be talking about credit next, but this is first and foremost because without earnings and financial performance and showcasing best practices in a bank statement, you'll never get to an approval, ever. You'll never be able to illustrate the ability to repay, which is what banks and lenders are thinking about. Will this business repay me? Will the personal guarantor, the owner of the business, will they act responsible? Will they repay me? How do we find this out? Well, ability to repay, and historically have they repaid. So ability to repay is where we're going to begin. That's going to be, do you have any days negative? Do you have any NSFs, non-sufficient funds, return checks? These are no-nos. These are indicators of, again, negative repayment ability, which will be very concerning for an institution. Now, average balances. This is another key point and metric that banks are very interested in. This showcases how much you remain and keep in your accounts at all times. So keeping a high average balance or a multiple of the payment, that's going to secure greater approvals and give you the greatest likelihood of approval for most credit and bank lending programs. Very important. Again, when you're going negative, you're showing negative repayment ability. When you show these not best practices of not maintaining a multiple of the payment in the account, you run risk of them immediately declining your application because of repayment ability.